In this video, we're going to talk about journal entry, and I'll give you some examples for that. A journal entry is used to record a business transaction in the accounting records of a business. A journal entry is usually recorded in the general ledger. The general ledger is then used to create financial statements for the business. The logic behind a journal entry is to record every business transaction in at least two places, known as double entry accounting. For example, when you generate a sale for cash, this increases both the revenue account and the cash account. Or if you buy goods on account, this increases both the accounts payable account and the inventory account. The structure of a journal entry contains the following elements. A header line may include a journal entry number and entry date. The first column includes the account number and account name into which the entry is recorded. This field is intended if it is for the account being credited. The second column contains the debit amount to be entered. The third column contains the credit amount to be entered. A footer line may also include a brief description of the reason for the entry. The structural rules of a journal entry are that there must be a minimum of 2 line items in the journal entry and that the total amount you enter in the debit column equals the total amount entered in the credit column. A journal entry is usually printed and stored in a binder of accounting transactions, with backup materials attached that justify the entry. This information may be accessed by the external auditors as part of their year-end investigation of a company's financial statements and related systems. Let me give you some journal entry examples. So we will record the following transactions as journal entry. The first one is the transaction where we invested 100,000 cash in business. In this case scenario, cash will go up, so we will debit it, and capital will go up as well, and we credit it with the same amount. The second transaction is we purchased a used car for $2,000. We debit, in this case scenario, property and equipment account for $2,000. We will credit cash for $2,000. Credit makes an asset go down, so it shows that cash goes down in this case scenario, while property and equipment is an asset and it goes up as we debit it. The third transaction is that we purchased supplies on account for $500. When we purchase on account, it means we are not using cash. Supplies, being an asset, will go up. So we're putting 500 for supplies going up to debit it. As we're not doing it with cash, it means it goes into accounts payable. Accounts payable is money owed by a business to its suppliers, shown as a liability on a company's balance sheet. So we have an asset going up and we have a liability going down by $500. When we pay the account payable liability off, the journal entry will be reversed. Let's just do 3.1 here just to show what will happen. Accounts payable will go away with a debit of 500, and we will pay out the cash that we owe to the suppliers with a credit of $500. The next transaction is number 4. We paid $350 cash for advertisement. In this case scenario, advertisement expense will be debited for $350, and we paid for this expense with cash, so we will credit cash for $350. Perfect. The following transaction is that we billed customer $5,000 for services performed. We only billed customers. That means we are not receiving the actual payment yet. So there's no cash in this transaction. We do have an asset though, because the client owes us money. That would be accounts receivable. Accounts receivable is the balance of money due to a company for goods or services delivered or used but not yet paid for by customers. So accounts receivable will go up by $5,000. And to balance this transaction out, we have an equity in a form of revenue for the services delivered to the customer. So the service revenue will be credited for $5,000. The next transaction will be related to the previous one. So we received $2,000 payment for a bill in transaction number 5. The client didn't pay the full amount of $5,000 yet, but they paid $2,000. It happens. Sometimes the bill is paid off in tranches. We know that we are receiving cash, which means we'll debit cash for $2,000. The tendency is to want to credit revenue now, but in fact, we've already recognized the revenue in transaction number 5. So if we credit the revenue again, we're going to double count it and we'll have $5,000 and $2,000 revenue in our income statement when we only want $5,000, which we've already recorded. So what's happening, the accounts receivables are actually going to go down and the amount that the clients owe us is actually going to go down. So we credit accounts receivables for $2,000. If you draw a little T account for accounts receivables, when we bill the client, they owe us $5,000. And when we credited accounts receivables in transaction number 6 for $2,000, we will show it here. This way, the balance that the client owes us after that is $3,000. Journal entries and attached documentation should be retained for a number of years, at least until there is no longer a need to have the financial statements of a business audited. The minimum duration period for journal entries should be included in the corporate archiving policy.